Hi, everyone. Thank you so much for joining. We thought that we would hop on, have a market live because there's been big news. There was a trade agreement between the US and China agreed over the weekend. It was announced first thing this morning. And I would like to say we are back in a bull market for US stocks. Now, we're going to jump in, take a look at the charts straight away. So that we know what we're looking at. So if we can just take a look at the charts, that would be wonderful. Here we go. Now, this is what the gains that we've seen today. So we're looking at global equity. Oh, actually, we're looking currently at commodity markets. Let's switch to equity markets. But here are the equity market gains. And I just follow my pointer. As you can see, 2.8% gain for the S&P 500 and near 4% gain for the NASDAQ. So this has been really, really good news for the tech sector. So this is being led higher by big tech. We've got an 8% gain for Amazon. We've got over 7% gain for Tesla. We have gains of over 5% for Nvidia. This is all really good news because tariffs between US and China, they have fallen really, really sharply. This is better news for global growth. It's reducing the need of panic in the market. It's allowing those growth stocks like big tech to power ahead. Now, I pointed out that we're back in a bull market, and we are, because in the past month, we are back. We have seen a rise of 11.49% in the NASDAQ, 8.51% in the S&P 500. That tells us two things. The first thing, we're back in a bull market. I'll say it again. The second thing, it pays to stay invested and also to be greedy when others are fearful, which is, of course, that famous Warren Buffett quote, because it really has paid off. Buying when things were selling off, really high quality companies in the US were selling off really sharply, has been rewarded. And I think, what we've seen with the trade agreements has taken about a month of a little bit of uncertainty, what's going on. And then, now we're seeing them come thick and fast. The next ones, we hear that there are negotiations with Japan and also with India, and then hopefully at some point the EU, but that's slightly different, and we will talk about that in a moment. But I just want to show you the NASDAQ 100 chart. So this is the NASDAQ 100. It's a daily candlestick chart. As you can see, a big gap. Look at there on the right-hand side, a big gap higher today on the back of that much better news about tariffs. So total tariff relief. It feels like we've gone past those April 2nd declines. So we're now higher than we were back in April 2nd. We're at the highest level since the start of March. Now, a couple of things I want to draw your attention to. You may remember that, about a month ago, we were talking about how the index, the NASDAQ, was below the 200-day moving average, which is the yellow line on this chart, and how nothing good happens below the 200-day moving average. Well, today we've broken back above that 200-day moving average. So that came in at 20,190. We're currently trading at 20,800. So really shot above that level, which suggests that momentum is very strong. We've obviously got to close out today, but it seems like the market this rally could have some legs. The second thing I'd like to point out to you is that we're still quite a way off from that February high on the 19th of February when we went over 22,200. So there is still some catch up to be had. Will we get back to record highs? That was a record high, by the way, that high in February that you can see the pointer is on right now. Will we get back to record high territories? Now, there's a couple of schools of thought here. The first one is, well, actually, this is really good news for the US economy. They've reduced tariff rates from 145% to 30%. This is going to mean that the US is going to be open for business, so people can invest in the US and then they can export all over the world. So that would be great for everything from growth, GDP to productivity. Hopefully we'll keep inflation down as well. I mean, that is like a pipe dream, I think. I think we're looking too far ahead. The other thing that I would point out on the downside about, essentially just tempering some of these gains, even though we may see more gains in the coming days, but we might not see another record high. And the reason why is because we still have 30% rate tariffs on Chinese goods. Back in January, middle of February, we didn't have that 30% tariff rate. So we've still got tariffs on goods. They've just come down very, very sharply. So China has lowered its tariff rate on the US to 10%. So there's no trade embargo between the world's two largest economies. And that is a good thing. And that is very much being celebrated in the markets today, as it should be. Let's go to commodities now. And again, I'm just showing you a broad overview, and then we'll dig a a little bit deeper. But this, as you can see, Brent crude oil up by 2% today. Now, it had been up as high as 3%, but it probably had gone a little bit too fast, because remember, we've got all these that extra supply coming from OPEC. So that will temper the upside in oil, but we are around about $65 a barrel. We had been above 66. So it suggests that the market isn't necessarily comfortable above $65 a barrel for oil. 2% gain, it's good. It's not outstanding. Let's take a look at where I'm moving the pointer down to now. We've got gold. Gold has fallen $101 today, so down 3%, complete inverse of what's going on with stocks, because it was the ultimate safe haven. It was what everybody was piling into when they were really worried about the end of US exceptionalism. Now, what I would say is that today's deal, will it lead to the US trade, the US exceptionalism trade again? I think there's a place for recovery in US stocks, but I'm not sure we're going to get that real exceptional animal spirits going again, like we saw in 2024 and also in the start of 2025. Famous last words, of course, but I think that we could just see a little bit more of a tempered rally this time. So it is good news, of course, but I think there's still a good case to be made for regional diversification in stock markets, and I think that's what the market's telling us. But definitely not a good day for gold. In fact, I will show you the gold chart. Just bear with me, guys. Because I think it's worth looking at, because obviously gold had been at those record highs, still comfortably above 3,000, but I think we're approaching a really, really key level, that 3,200 level. As you can see, it held back at the start of May. It was kind of a bit of a holding pattern. Will we fall below there? Will we get to the 50-day moving average? Apologies, 3,137. So that would be another $90 drop from where we are now. We're still well. There's a lot of support on the way down. So there is still room for it to fall. But we just need to see. The other thing we would also point out with the gold price has come off without a shadow of doubt. But just because these tariffs have been announced, we haven't seen gold drop below that 3,000 level. Still looks very comfortable above there. So it does suggest that there's a little bit of residual worry in the market, because remember, tariffs are still paused with other countries for 90 days. These trading deals are still very, very complex, and they're still thrashing out the details. There's a 90-day reprieve for China as well. So if they don't actually agree the details of what sectors come under what tariffs, then we could see a bit of panic set into markets once again. But that is not on the mind of equity investors now. As usual, they've just piled in, been desperate to buy US equities. But I think that's why we're seeing, even though we've seen a big decline in the gold price, we're still hovering above that 3,000 level. I don't necessarily think that will see us pushing back to earlier 2025 levels quite yet. The other big move today was in the euro. The euro has been absolutely battered since the US announced that reprieve of 90 days on global tariffs, and it took another leg lower. As you can see, this is euro sterling chart. That's also looking very, very weak, because again, what's conspicuous by its absence? Conspicuous by its absence is the EU trade deal. That's going to be very, very complicated for them to achieve. I'm going to show you euro dollar, because that's also a really interesting currency pair at the moment, because the dollar is the best performing currency in the G10 FX space. Look at the size. This is euro dollar chart now. Look at the size of this candlestick on the downside. Now we're testing a really, really key level, 110.75. We're around there. If we get a close below that level at some point later this evening, that would suggest that momentum's to the downside. It looks like it is to the downside to me anyway, certainly with a move potentially back towards that kind of 108 level. I think there's good support there in the 200-day moving average, which comes in at 107.89. So I wouldn't see us having a bigger move down there, but I think a break below, maybe another test of 110 could certainly be on the cards, because again, no trade deal with Europe, and the mood music is not great either coming out of the White House. They're still saying that it's quite difficult to get those that trade deal across, and I'll just show you how that is. As you can see, the only currencies that are weaker than the euro today is the Japanese yen and the Swiss franc. Now that's completely to be expected because they are the big safe havens. So they've been sold off as people have piled into equities. The other thing that's sold off, this is bonds. Remember, when yields rise, we see bond prices fall. Look at that, 10 basis point gain in the US dollar. That's really in the US Treasury, sorry. That means the price has gone down. That's really benefiting the US dollar. We've also seen gains, again, all across Europe and the US as well. Let me just, that chart came up for no reason. We're going to go back to this one again. Oh, look, NASDAQ up by over 4% already today. So that's certainly worth watching. And as I said, let's take a look at NVIDIA before I go. NVIDIA is now testing that 200-day moving average. We're still away, a bit away from that all-time high on the 7th of January. But we are testing the 200-day moving average, 125. No, we're nearly testing. We're nearly there. Sorry, we're testing the 100-day moving average at 122.30. So we're above there. So 125 is the next level to watch. So we will be watching that closely. Again, as we said, if we can get above that level, that's where the good things happen. That's where we see that increase. Tech has obviously been massively oversold. It's still down by $25 since the start of the year. So it's still taken a bit of a battering. That's something to note. Last thing I do want to show you is the FTSE today, because let's look at the FTSE. The FTSE was a bit of a lagger, and the reason why is because Donald Trump has done some crazy thing, done some big changes to pharmaceuticals and to everything that's he's basically reducing prescription drug prices in the US, or trying to, by not a small amount, by 30 to 80%, depending on the medication. So hence why, yes, we've seen that pop higher. We've gone back, we've erased all of those losses from Liberation Day, but we haven't really seen a big enough move on the upside there. Now, that's a big difference to Europe, where the DAX has actually reached a record high. It reached a record high on Friday, actually. But the FTSE, why hasn't the FTSE followed suit? I think it's because we have those big GSK, we've got AstraZeneca, they all fell more than 3% today. And so they're weighing on the ability of the FTSE 100 to move higher. But today, it's all about the NASDAQ, it's all about big tech, it's all about the weaker euro and a stronger dollar, a weaker yen as well. So I am going to leave it there, guys. It's been, thank you so much for joining. Good luck trading, and please join us for the next one. Thank you.